Hello and welcome to this special episode of Have We Got Planning News for You? Tonight, in conjunction with the Royal Institution of Chartered Surveyors, we're here to discuss the new RICS guidance note assessing viability in planning under the NPPF 2019 for England. The guidance note was published a few days ago at the end of March after a long preparation and consultation process. It's been eagerly awaited and already causing some interesting discussion in the industry. So we thought there'll be no one better to discuss this with and help us through the key messages from the guidance than its lead author, Professor Neil Crosby from the University of Reading. Neil, good evening. Thank you very much indeed for joining. Where are you calling us from this evening? From
home in Oxfordshire. So I haven't been to the university for a year now, which is I think I still know where it is.
Where it is. Well, I'll say we're delighted to have you with us and looking forward to hearing your insight on the key messages of the guidance note and how it came into being. And it's a guidance note which, if you've got it to hand, any viewers, on about the fourth page under acknowledgements, the final line refers to our very own Mary Cook. We are grateful to Mary Cook, barrister, Town Legal, who provided valuable comments on an earlier draft. So doubtless Mary can provide us with some insight too. And indeed, I was a member of the RICS Standards and Regulation Board that approved the guidance note. So it's something that I've been familiar with too. So without much ado, let's introduce the panel before we get cracking. So as always, Mary, over to you in your gallery. Once again, the lights are dim this evening. Can't see your lovely pictures.
Good evening, Neil. It's a pleasure to have you. Welcome to the show. Mary Cook, Town Legal, and I'm looking forward to this edition. What are you drinking, Neil? You haven't been asked what you're drinking.
Yeah, the alcohol will come later.
Great, thanks, Mary. Paul, how are you?
I'm very well, Charlie. Good evening, Neil. Nice to see you. I'm Paul Tucker, King's Chambers. I didn't get the memo with regard to a theme. Now that I know that Neil is a Forest supporter, and I was as a child dragged to Forest matches, it should have been Nottingham, but logically I brought some Turkish beer. So cheers, Neil.
Cheers, Paul. Sasha, nice to see you and Paul in coordination in your choice of shirts.
Yeah, thank you, Charlie. I don't want you to get an inferiority complex from Britain's #1 university. But there we go. I also wanted to thank Neil for the lending of the shirts 100 years ago. Forest lent Arsenal shirts, and that's why we play in red. So thank you very much. Repay the debt. Thirdly, I'm in London and I am drinking tea. I'm taking Neil's lead. Those of us that take viability seriously stick to tea when discussing such matters.
Hence my beer.
Superb. Chris, how are you?
Very well, Charlie. Now we've finished Lent, I am back on drinking alcohol, and I am not going to waste the opportunity. I've got here some Reading Gold.
Wow.
I've got one for every occasion, and I've got this as my way of opening it. Beer, making you see double and feel single. And I'm very pleased to say that Presumption is here. And he is looking like a surveyor because he's got his surveying apparatus. And he's also got a calculator here. And as we'll discover a bit later, the plus button appears to be broken.
Oh, very good. Very good. Well, Charlie Banner here from Keating Chambers. I'm in Chambers today, back in a series of virtual meetings. I'm drinking Coke Zero. I'm afraid to say I need the caffeine before we start engaging in things like number crunching. So I'm dosing up on that. Great stuff. Well, let's start our chat with you, Neil, about the guidance note. Here it is, as Mary has already waved it in front of the camera. First things first, I mean, there already was a financial viability and planning guidance note published in 2012, much discussed at planning inquiries and hearings. What prompted the preparation of this new one?
It's just out of date, basically. It was produced. I was actually involved a little bit in the production because we did some research in 2010 for the RICS in preparation for this guidance note. So that predates the NPPF 2012 and the PPG 2014, and so much happened sort of since then that the guidance note just literally came out of date. Competitive returns was changed in the new PPG. I think the one thing that I would say is that I think that guidance note was misrepresented quite badly as time went by, because I think it actually had a solution to the problem, which was policy compliant value. And that policy compliant bit got, I think, moved around, and policy compliant definitions became really quite important to some of the problems that came up with the PPG 2014, which led to, I think, the government changing it in 2018, because it just wasn't working.
And what was
so we need a new one. And Holgate, of course, if you remember Parkhurst Road, I mean, he said, I mean, it was already being looked at as being changed, but he really prompted it and suggested that it should be done in consultation with Law Society, MHCLG, RTPI, and that's what eventually happened, is that the working group had all those people on it, although MHCLG were observers rather than, but they did put some clarifications in there occasionally. They didn't stand back completely.
Tell us a bit more about the process. So you were lead author, as I mentioned before. Tell us a bit more about the working group and the consultation, both the kind of public consultation and any sort of direct stakeholder consultation.
Yeah, I mean, the lead authorship thing actually came through time. I was just initially a member of the working group, and it was a question of I started drafting quite a lot of the valuation-based material. And in the end, I ended up with the job of doing all the editing from the legal review that Mary did, and from the consultation, which we had. I think it must be at least well over a year ago now. I think it was end of December 19 into the early part of last year. And I'm not sure if this is correct. I heard somewhere that the consultation that the RICS did on the first draft had the largest response of any consultation there's ever been. I think there was about 500 separate comments from about 100 and something. I mean, I don't know the numbers exactly, although I have got a spreadsheet with every single one of them on it, and our response to every single one. But I think it was 100. It was 100 and something respondents. So it did generate quite a lot of interest. So I'm assuming that the final version is going to generate quite a lot of interest as well.
Indeed, and it already has. I mean, one email, in fact, circular that I received today from a particular firm commented that it has taken quite a while to prepare. Relevant PPG change, I think you're right, was 2018. It's now 2021. What's meant that it's taken that period of time to produce?
Why is it taking so long? Well, the first one took literally. It was two years for the first one, and I think it says it all. There are many different views about viability from different perspectives. And the working group, quite rightly, had a wide variety of perspectives on it. And there was some lively debates. I'm almost choosing my words carefully, but not that carefully. I mean, we had some good old discussions, to put it mildly. And almost every word had to be dripped over. It was the longest. I've done quite a few guidance notes for the RICS in the past and other ones, and this was by far the most. I'm trying to think of the right word, but it took longer than any of the others. That's for sure. I think you get the gist of that one.
Absolutely. In fact, I've got a question later on about how you sort of struck the balance between providing meaningful guidance on the.
The consultation was fascinating as well, because if you look at the individual responses from the consultation, you couldn't get a wider, that variety of views was absolutely there. I mean, half of them thought we'd gone too far and we hadn't kept to the PPG close enough, and the other half thought we hadn't gone far enough. A lot of the discussions were about policy. And of course, I think the important point to make very early on in this is that this guidance note follows the PPG. It does not try and change the PPG. That is not the job. We may all have very, very different views about what the policy should look like. And many people, I'm sure, would think that the PPG isn't what it should look like. But that wasn't our job. Our job was to follow the PPG. Where it was light on detail, we thought we had to try and help the interpretation. And the way in which we approached it was to say, we're going to use the PPG as the authority. I mean, there's an actual word in the valuation standards, which is authoritative requirement. So that is the absolute baseline. And if it conflicts with normal valuation process and practices, then the PPG takes precedence. But where the PPG was silent or possibly ambiguous, we felt we had to go that step further to actually suggest ways in which it could be implemented. Because on its own, you can't implement it totally on its own without some help.
And
how I see it.
Is there a vulnerability in the sense that the PPG can be changed at any time? It could literally be being changed on the website right now, without consultation, potentially, at least in principle, without any sort of foreshadowing, and that could, at the click of a finger, render the guidance note out of date again. Is that a vulnerability? And
it is a vulnerability, but whether it's a probability, I think is doubtful. I think that they're looking at different ways of doing it. So this will have a shelf life of possibly 2 or 3 years, I think, when the new policy, whatever it may look like, will come in. So I cannot, if they're actually thinking of whole new ways of doing this, they're talking about the SIL, aren't they, in the paper that came out last year. So I think it's highly doubtful that they're going to make major changes to the system until they've actually thought it through completely and have got a much more detailed view about what they want to do. And that's why I think it's got this shelf life of 2 or 3 years. And our discussions with government have sort of confirmed that. So I think, yes, it's a massive vulnerability. And that's what happened to the old one, of course. As each piece of information came out, it got less and less relevant. And yet it was still being applied, but it actually hadn't got any basis in what was happening. So, to me, it became, I think it was a liability, but a lot of people used it all the time.
Yeah.
So, that sort of completes this circle of why it needed to be changed. And the reason it took so long was that, as I said before, it's just the different views. They are total, aren't they?
Before we get onto the sort of substantive content, one last general question, which is, this isn't, of course, the first RICS publication on viability and planning since the changes to the PPG in 2018, because in 2019 there was a professional statement published also on financial viability and planning. Can you just explain to the uninitiated what's the difference between that professional statement and the new guidance note? What different roles they seek to serve?
Well, I wasn't actually involved in producing. I was on the working group, but I wasn't on the small group that produced that particular document. But the reasoning behind the document was because we knew it was going to take, given our experiences with the first one and given the initial discussions within the working group, it was obvious that it was going to take us years rather than months to get this guidance note out. So the position was taken that we needed something out there to control the conduct of the process and the reporting of the valuation content within the viability studies. So it's basically it's a mandatory professional statement, and it's mandatory on RICS members. And it actually sets out how they report the conduct, conflicts and things like that, and how they report, and that's all it does. Whereas the guidance note is obviously much wider than that. So it takes that it takes PPG and the professional statement as its absolute underpinning bottom line, and then the guidance note builds off those two documents using the other guidance that RICS produces on, for example, the valuation of development property. There was a new guidance note for valuers on that in 2019. And so where there is, shall we say, I'm going to use the word ambiguity, but where the detail in the PPG isn't absolute, or even where normal valuation practice and what's said in PPG diverges, and there's plenty of that. We sort of use the valuation guidance note as the counterbalance to sort of try and say, well, if we're not sure how to do it, let's see if we can refer to that, to try and keep it as objective as possible.
Understood.
So we try to anchor as much of this as possible in documentation, like the other guidance notes, but mainly the PPG and the professional statement.
Just turning then to the individual chapters, I know the others have got some questions, so it may be that the rest of the panel want to chip in when we get to the relevant points, or deal with their questions at the end. It matters not. But chapter 2 is entitled FVA's Financial Viability Appraisals in Planning and Development, and it talks about the sort of role in general terms of financial viability appraisals and viability principles. What are the sort of key take-home messages from that chapter on the role of viability assessment and the central principles applicable to it?
Well, I think first of all, that chapter 2 was discussed in some detail. There was some even discussion about whether we needed this at all. My view is that it was absolutely necessary to put the context, to lay the context for this before we got into the real detail. First of all, it was to say that times had changed. There was some evidence that the viability studies post 2018 were not changing as quickly as perhaps they should be. So, I mean, obviously the guidance note took too long, it's taken too long to come out. So there's a bit of a contradiction there. But I think that, first of all, to reinforce the message that current government policy is very different to what it was previously. The PPG has absolutely shifted the emphasis from site specific to area wide, and I think that is a massive change. And in trying to solve the issues with site specific, some might say that they've raised just as many difficult issues with the area wide. And I think there's a discussion, perhaps later, there's a discussion to be had there about whether local authority, whether it's asking too much of local authorities. My view is that if local authorities do not take this really seriously and start to put resources into getting the area wide part of this right, then the contributions will not flow, because I think the developers and the landowners will take this part very seriously indeed, if the local authorities don't as well. So, should they put resources into it, and should the government put resources into it, I think is a good question that we might come to later. But so I think that there's the area-wide site-specific issues, but I think there are a number of sort of valuation issues, and I'm going to be very rude now and suggest that many of the stakeholders you're all smiling, I'm not sure you will be in a second, many of the stakeholders do not get the minutiae of valuation. And you may think that's very arrogant coming from a valuer telling the other stakeholders. Well, I could be speaking to a whole lot of valuers as well. I'm going to upset everybody here. I'm not just picking on you lot. In other words, I think valuation theory and practice is not as simple as some people make out. And if you start to write valuation guidance without understanding precisely what's going on, in a sense, under the skin, you will write things that don't work. And you might then take the inference that I'm suggesting that there's a lot in the new PPG that doesn't work very well. But I'd go much wider than that and say there's quite a lot of stuff in traditional valuation practice that doesn't work very well. So there's a whole sort of raft of issues here, which is about valuations, how they're done, and and of course that leads to what I'm going to call asymmetry of knowledge. And there is a lot of literature that suggests that the resources of some stakeholders in this are a lot better than the resources of others, and you get what you pay for in terms of advice, and therefore you might get sort of advantages from having this asymmetry of knowledge and expertise. Now, I'm not for 1 minute suggesting that all experts are bent. but there is actually a lot of evidence to suggest that experts in all fields, including law, it's not just the valuers, but it's, expert evidence often has an element of advocacy in it, as I'm sure you as barristers have seen on numerous occasions, and professional valuers are not immune to that. And it's not really bias. It's actually valuation variation. There's this element of within valuations where there's so much opinion that it's not being biased to choose 210 instead of 200, because it's within the realms of possibility. And if you get into development appraisal, it is well known within this particular aspect that the residual amounts coming out of development valuations come from two very large numbers producing one much smaller number. And it doesn't take much in normal valuations, never mind, but this is way beyond viability. This is in any development valuation. A tweaking of this number here and a tweaking of that number there can produce a massive issue with the residual element. Now, it's very important that everybody understands that the dangerous element is that final residual element. And I have produced one paper that talks about a game of pass the parcel, and it's called Pass the Residual Parcel. And if you can make the planning obligations the residual of a development calculation, it's so easy to make them look really small. Now, you could say, on the other hand, it's quite easy to make them look really large as well. In other words, I think that holding the residual is the dangerous place to be. Now, most valuations would say the land element is the residual element, but the old PPG allowed that to be reversed. And so what we saw was, in my view, increasing profitability with decreasing affordable housing. Those two things should not be happening at the same time. And so I think the government decided that the old system wasn't working because it had been gamed around, and the planning obligations had become this residual. Chapter 2 and Chapter 5 are attempts to stop that happening again. Now, whether they will be successful is another matter. So I'm sorry I've given such a long answer to that one, but I think it's crucial that the valuation nuances are well understood by all stakeholders in this. And I'm hoping that this guidance note refers to some of that. Now, it couldn't refer to all of it, so I'm going to suggest that you start reading some of the academic papers as well, which are less constrained and in terms of discussing these things very openly, because the RICS can't take a view of one side or the other.
Sure.
So I think, it was a fine line between being absolutely objective, but trying to identify what the issues were. And these issues were what the consultation with government was all about in 2018. So I thought it was important. And as I say, I still think it's very important to talk about these two chapters, 2 and 5, in some detail.
And that's presumably why you called Section 2 the FVA framework. The principles set out in 2 are the framework for understanding and then applying the guidance that follows.
And I wouldn't wish this discussion to be a sort of attack on the valuer, expert, witnesser. I don't think it is at all. I think it's an absolutely recognised nature of this beast, that it is a very, very difficult valuation because it's small numbers coming from very large numbers. Variation in those large numbers creates valuation. I'm sure you lot have all heard of the margin of error in valuation negligence. Well, that's completely the wrong term. It's not a margin of error, it's a valuation variation. And it's totally predictable it's totally normal to have a huge valuation variation in a development valuation. It's not an error. So if you lot could start calling it something else, I'd be very grateful, actually.
That's your public cry for that. So
yeah, okay.
exactly. Point taken and point noted. Chapter 3 then deals with the different roles of viability in the context of plan making on an area-wide, local authority area-wide basis, and then decision taking in relation to particular applications. And I'll ask you to outline the key messages from that, but it operates in the parameters of what the PPG says about the primary basis for viability appraisal being at the local plan stage. I mean, one of the comments that's been made today in the note that I've seen from a particular firm is the challenge that in that context is that the lifetime of a local plan, the turning circle of a local plan, at least for now, is 5+ years.
Yeah.
Yet market circumstances change quite often in a much more volatile fashion, and so there's a sort of inherent tension there. So a bit welcome
Absolutely.
your thoughts. Paul's got a question, associated question that way, but welcome your thoughts on that. And again, to those who perhaps haven't yet had a chance to read the guidance note, what would you outline as the key messages from chapter 3 on those differing roles?
Yeah, I think in a sense it feeds into the other chapters as well. I mean, chapter 3 is basically a process chapter about the plan making stage, and it was felt necessary to have a much more detailed look at the actual process of producing the plan, because it had been put at the front of the whole thing. So it was obvious that and in fact there's an appendix as well, and in the original draft the appendix was huge, and so it's been pared down and pared down and pared down, but it's still quite a substantial element. And I think it has to be. And that brings me back to that point I was making about some of the sort of comments that we've got about, can't we please keep it simple? Well, if you want to keep it simple, you then open the door, I think, to a lack of balance within the system. And I think, the local authorities who are suggesting let's keep it simple and keep and don't put much resources into the plan making, it has become the base for what happens, as you say, over the next 5 years. So to have appraisals that are very simplistic and don't think about what might be happening over the next 5 years is, I think, it will defeat the object of the plan making. Because if you get too much change during that 5-year period, it opens up the door for site-specific to come back and bite them, basically. And so I think that there's a message there that if you shortcut on the area wide, it will cause you problems later on. Now that brings us to another point, and this is really controversial in valuation circles. I don't know if it's, you will recognize this as well, but the conventional wisdom of viability is that you use current values and costs. Yeah. And it may even have been specified in the previous PPG. I can't remember. Yeah. But this PPG does not do that, even though there's a view that it does say that, but it doesn't. But it opens up what I would consider to be good valuation technique. Now, there is an issue with methodologies prescribed in a PPG or in any guidance manual that don't precisely fit with what's actually happening in the pricing. And I believe that in land pricing, any developer that thinks in current values only is it's not how they think, is it? I mean, I suspect that what we do is we think about what's going to happen, because in development it all happens in front of us.
Yeah.
And so, not to think about what sort of market we're in and where that market might be in 2-3 years' time at the end of the development would be, it'd be almost criminally insane, wouldn't it? So therefore, I think to have a valuation technique that doesn't take into account the way in which real participants in markets will be thinking has got to be wrong. And that's another area where I feel that the old system didn't work, because if you look at viable developments, they are looked at in current value terms. If they're looked at in current value terms, then they will always undervalue. Because if you grow the GDV and you grow the costs, it grows the residuals. And so in a very, very basic term, if you have current values using nominal inputs like interest rates and discount rates and what have you, then you are going to undervalue quite significantly. And so I think that there has to be some reference to good valuation technique, and the PPG does not restrict you from doing that. Now, you then have to talk about proportionality. I mean, there are some sites and typologies that are small and don't require this sort of stuff. But you look at some of the appraisals being done on some of the major schemes, they're not going to be a simple basic residual. But if they are, they may be missing a trick. And some of the longer schemes require, I think, some more sophisticated cash flow analysis. PPG does not stop you doing that.
And that's another
word. Just to answer, the only word where it says current is where it's talking about EUV, and it's talking about current information on EUV. And I think that's not always I don't think that's been noticed, because I think a lot of viability studies still use current values and think they have to. And Mary's nodding. I don't know if that's your experience.
Well, we discussed this. I seem to remember there was quite a heated debate about this.
Yes, I can think of one illustration where that approach worked extremely well for a very well-known client in prime London, but I won't bother to say more than that.
By using current values?
Yeah, absolutely.
Yeah, it worked very well. I'm sure it did.
Current sales values, which probably about half what they ended up getting.
Exactly.
In Knightsbridge.
And it would have been a bit, not all of it, but some of it would have been predictable.
Yeah, absolutely. That was their business case.
And forecasting is a hugely difficult thing to do, and most analysts get it wrong quite regularly. Some of the analysis of forecasting is quite embarrassing, but much better to try it than not to, because I think there's another view that the way in which you put time into this is by using sensitivity analysis. So you use current values, then you put sensitivity analysis. That is not good valuation practice. Good valuation practice is to estimate what you think is going to happen, and then do sensitivity analysis around those estimates, not use the sensitivity as the excuse for not doing the estimates.
You don't see that.
All that is in there. It's hidden. It's in the guidance note in different places. And sensitivity analysis is now mandatory within the professional statement. But I think a lot of people will do sensitivity analysis on current values, and I don't think that's correct. I think they should be doing their best estimate and then doing sensitivity analysis around it.
What about viability review mechanisms? Similar sort of theme, really, about what does the guidance note say about that, and where do they stand now?
Well, it's trying to stop you doing it for straightforward. The development's gone wrong. My GDV has dropped. My return on capital isn't 20% or 15% anymore. It's gone down to 10. So would you please guarantee back to 15%, please? Now, I'm putting it like that because I'm hoping it makes it sound ridiculous. Do you remember, was it the Battersea site where they went back to Battersea, was it Wandsworth Council? You tell me. You know London better than I do. They went back to Wandsworth and they said, things have gone wrong. We're not making our whatever was in the viability. Can we have some, we want to give you less, whatever it was, less contributions. I can't remember what the contributions were. I mean, I read this as a headline, so I don't know the detail. But I immediately went, you've got to be joking. Because Wandsworth apparently said, yeah, fine. And where's development risk in all of this? I think if you take no risk at the moment, you get 1%, you get probably 0.1% of per annum interest, don't you, as a risk-free rate of return. So when we start talking about 10, 11, 12% internal rates of return on development schemes, you are getting 10 or 11 or 12% risk premium. Why? Because you're taking a risk, and development is a huge risk, and therefore the projected returns are very, very high. Because there is a danger that you might dig a hole for yourself, literally, but there's also, of course, a danger that you'll make double that, and you'll make 40% or whatever it is, and that is the risk that you take. What the local authority was being asked to do in that particular case was underpin the risk, was actually underpin the return. It's a risk-adjusted return with a floor. That's called risk-free in every other financial state. I mean, that was outrageous, in my opinion, in terms of principle. Now, it could be that the detail of that was completely different. Is it libelous or slander? You don't know the difference.
Why is that outrageous, Neil?
But as a principle, it's absolutely outrageous.
But why is it outrageous? Because we're in a planning system. This is not about us financing developments or local authorities second guessing. It's a planning system, which fundamentally is just about whether, in principle, a particular land use is acceptable. We've created, over the last 30 years of my practice, this incredible beast which tries to shave off the profits and views it in the sort of terms that you have, which is to say, well, why should that risk then be borne by the authority?
But it's not shaving off the profit. It's the developer's profit is still being talked about as being. I mean, it should be talked about in internal rates of return. It should not be talked about as a percentage of GDV, because that has no time frame.
The planning system.
But regardless of that, let's say it's giving developers a 15% internal rate of return. Then the reason they are projecting a 15% internal rate of return is because they are taking huge risks. And it's not for the local authority to underpin a 15% internal rate of return, and that's what is actually happening. That is outrageous, because it's not a risk. You're not taking a risk. If every time you fall below a massive return, you get the local authority to give it you back, what sort of financial system is that? I'll have it every day of the week, please.
It seems to me
one of those.
It seems to me, Neil, that we're running the risk, aren't we, of actually wanting to rewrite a little more clearly, I think, the PPG, because what you're saying is that the PPG shouldn't refer to somewhere between 15 and 20% developer profit on GDV. You're saying actually what it should deal with is the internal rate of return, and that if that internal rate of return is fixed at, say, 15%, then that ought to be the end of it. But that's not actually what the PPG says at the moment.
No, it doesn't. And what we've done on the guidance note is discussed how we might do valuations so that they accord with what the PPG requires, which is a 15 to 20% return on value, a single return measure on the gross development value. What we've suggested is that because that measure is very, very, simplistic, we've suggested that when you are looking at viability appraisals, in addition to looking at 15 to 20% of GDV, you also report the internal rate of return. And that might well steer whether you get a 15 or a 20. In other words, if we're going to use those as the top and the bottom line, if it shows that a 20% return on value is a 30% internal rate of return, we might just start thinking about what's the appropriate return, and it might not be 20, and vice versa. For longer schemes, the IRR will drop, because if you have a fixed rate of return, what you want to do is short schemes, because some of the internal rates of return on 15 to 20% return on GDV, you had a 6-month scheme, that's about a 40 or 50% IRR. I mean, it's not how real financial modeling works. Simple residual valuations using simple residual methods are not how the thing works. But this is what we've been given. So what we've got to try and do, in my view, is follow the PPG, but try and illuminate it by doing these other analyses, these other things, and that's what the guidance note has done. Now, some people may think that's gone too far. And in the consultation, we got people, just about this equal number of people who said we have gone too far in the discussion, and against those who said we haven't gone far enough. And I'm afraid we took that as being almost vindication that we've probably got it about right, which you may think is arrogant, but that's in a sense how I personally saw it, is that we were trying to get the balance right. So what we had never done and will not do in this guidance note is over sort of say that PPG is wrong, but where we think it leaves something on the table, we have suggested other ways and ways of looking at how you might try and interpret some of the numbers that you have to use, like the developer's profit and like the premium. And no doubt we're going to get onto the premium very soon, because
my next question. My very next question, really, because the PPG, you know, as we all know, enshrines the EUV plus approach, and I suspect the most hotly anticipated aspects of the guidance note, certainly amongst the legal profession, will be on what the guidance note says, I think particularly in chapter 4 and 5 and the latter appendices, about how you go about establishing the EUV and the plus and the premium. And the PPG says a little bit, but not very much. And perhaps fleshing out that theme that Mary raised of, how did you straddle the competing demands, if you like, of not putting a gloss on the PPG on the one hand and rewriting policy, but on the other hand,
right. EUV is absolutely essential in any way in which you might look at these. It's the bottom line, isn't it? The existing use value. Now, there's about a 13-paragraph appendix on just the issues about EUV, but I think they're valuation issues. So let's assume that we've dealt in the guidance note, we've dealt with the intricacies of EUV. I mean, the one thing I would say is that you can get when you start looking at sites that have been run down, perhaps in view of development, and or sites that have had some work done to prepare them for development. Often that either doesn't appear in the EUV or it reduces the EUV, but it doesn't actually reduce the development value. It might actually increase the development land value. So that's why immediately you start having questions about, well, a static premium across a locality, for example, would be completely inappropriate. So you start asking the question immediately, okay, let's assume that we can set up the EUV. What's the premium? And that's the question that you all want to know. And unfortunately, the reason you want to know it is that there is no easy answer. There's
no easy answer at the moment, because the government absents itself from any kind of decision on that. We nationalised the use of land in 1948, and this issue could be settled by government very easily. They could say that landowners should get a 40% share in the uplift in land value, free from obligation. So you were talking about the research. I mean, we do need to grapple with this, because yes, there's an issue about developer profit and sales values, but in the end, it all boils down to the land price. It really does. About a third of my practice is about viability, as is probably the case with everybody else here. It's a huge, huge topic, massive topic for those doing cases in London, a lot like Sasha and Mary. And the plus is frankly the main thing, and it appears to be the elephant in the room. Now, I appreciate that's off the remit of where you are, but can I just take you up on your research, because you said you need to have a look at the research.
You're very cruel at this point. Go on.
I'm just very
Don't you worry, we're not going to let him get too nasty.
I'm very gentle.
Very gentle.
Right. But you do say in the document we're talking about, you do refer us, don't you, to your own research on financial viability appraisals in planning decisions, theory and practice. And I had a look at that, And I went back to your endorsement of the Manor Shinfield approach for being equitable and responsive, more responsive than current approaches. So, I mean, what is your view? What is your view? I mean, do you think we should?
Okay, look, I have to now do the disclaimer.
Okay,
You know, I'm supposed to have come on here to talk about the guidance note and to say, and my line is without no ambiguity as far as I'm concerned, is that the line we have taken is that the PPG is the authoritative requirement. And, you know, you might add whether you like it or not. I'm not going to say that at this moment. And we have written a document that follows it to the letter, but then adds guidance on top of it. However, you are now asking me as a university prof about my views about land market theory. And I think you've had a little bit of that already. And I think the old system was flawed, completely flawed. And our solution, which the Reading research team on viability has been working for 10 years on, at least on viability, ever since we got involved in the first guidance note, as it happens. And we've produced a lot of papers on it. And Chris, the one you were talking about is one of those papers, but we've that particular one for the RICS, but there's loads more. And our view is that, subject to all the problems with residual valuations, doing a very simple, what's the residual land value excluding planning obligations, is the first part. EUV is the second part, and then some kind of split balance between the two. Now, this was put forward when we were talking about competitive returns to the landowner and competitive returns for the developer. And the residual valuation puts the competitive return for the developer into the residual land value. So that's part of that particular calculation. So they get their return. And we thought that a fair share of the uplift between the community, i.e. contributions, and the landowner was the way to go. And at least it would be completely understood within the valuation profession, and all the discussions would be about the valuations. What we now have is EUV plus, and again, as an aside, we did tell the government about our research, and we had an interview with them in the consultation, and we did put forward that we thought that EUV plus was not the correct approach, but that is the approach. So what we've now got to do is say, well, how do you implement that approach in the best possible way? And what the PPG says is that it sort of says there's a body of knowledge on what the levels of either percentage uplift or how many times the EUV the premium will emerge. Now, at the moment, I've seen viability studies that still take on the old sort of rules of thumb of plus 30% EUV. I mean, I think London is they use that quite a bit, don't they? And, you know, Greenfield land EUV times 10 or 20. Those are all rules of thumb with no technical backing whatsoever. They come out of the old regime. So they haven't really been, so there's no real market evidence of what premiums could be. So what we've suggested is that what you do is you do three things. You follow the PPG and you do try and assess what you think is a reasonable premium with no real technical backing whatsoever, but you might use the rules of thumb. What you do not do, absolutely do not do, is then place that value, land value, into a residual framework. What you do is you start from scratch and do a policy compliant residual land value. And we talk about emerging policies versus real policies, depending if you're at the plan making or the decision taking stage. But the second valuation you do is basically a residual land value using policy compliant levels. And then you do your policy compliant land price analysis. And of course, Holgate identified that you should always try and use transactions that are policy compliant as opposed to ones that are not, and you must adjust them. And that was a step forward, but it's not the total solution. So you end up with the two cross checks, which are the residual valuation land value and the benchmark land value from direct comparison with policy compliant transactions. You've then got three benchmark land values. Now the PPG talks about iteration rather a lot, and here's your iteration. In other words, if the three sort of endorse each other, then the rules of thumb are working. If you get one that's way out of line with the others, you question where the premium should be. And to me, it's just a question of taking all that evidence, and the valuation evidence is the residual land value and the land price. And we know that you're not allowed to use the land price to reduce the policy requirements, but that's not doing that. What it's doing is using land price as a cross check, which is exactly what the PPG says, using the residual valuation as a cross check. What you mustn't do, in my opinion, is to put the planning obligations into as the residual of a benchmark land value calculation. What you do is you choose the benchmark land value, and the final thing you do, having iterated between those three valuations, is then go back and say, right, what level of contributions will that benchmark land value allow? So yes, you do it, but at the end, you don't do it as step two. It should be step 4, not step 2. And what I've seen happen quite regularly is on viability since 2018 is they take the rule of thumb, a greenfield site, 20 times the EUV, stick it in, do the residual, and out pops the planning obligations. If you put enough infrastructure in, you can make them pretty small. I live in the middle of a very, very, very valuable place, i.e. Oxfordshire, and I've seen viability studies that wipe out vast tracts of the planning obligations, and it just seems to me there's something wrong there, isn't there? I would immediately start to question the valuation inputs. And that's what a good viability should be doing. It should be questioning the inputs that come to the answers and looking at all the different ways of doing it and iterating. That's what a good valuation is to me. It's not taking one and sticking it. Yes, PPG, primary approach, EUV plus. But that doesn't mean it's the only approach, and it allows the cross-check. Use them.
Last question for me, which is the guidance note is expressed to apply only in England, and that's natural enough because the PPG only applies in England. But we have viewers of this show in all of the other parts of the UK. I've certainly done a case concerning viability in Wales, not that long ago. What the heck is a surveyor meant to do in Cardiff or Edinburgh or indeed Belfast if they've got a viability issue? Are they meant to have regard to this guidance note? If not, do they go back to the 2012 one as a sort of relevant consideration, or is there anything else, any other sort of touchstone that they should be looking to?
Well, I think the title of the viability guidance note is England. Yes, in England. Therefore, I can't, on behalf of the RICS, say that valuers in any other place should take notice of it. However, what I would say is that you follow the rules of viability within your own jurisdiction, but you may find some elements of the guidance note and the valuation of development property and even the PPG in England as helping you to get to your outcome, but it's got to be within this was written with the jurisdiction of the PPG in England. It can't refer to anything else in officially, but I'm sure it can be. There are elements in there got to be useful. Sure.
It's relevant material. Understood. We've also asked questions we've gone along really, but just go around the four other panelists to see if there's any other sort of remaining questions that each of you got, starting as always with Mary. Any further questions that you've got for Neil, Mary?
Yes, I'm going to try and convert two of mine into one. My question was really about explaining what is meant by the divergence between market value and benchmark land value. value. What do you mean by that? That's the first point. And the second thing is just following on from that. Do you expect, or do you think that the government expects that divergence will disappear over time as market transactions reflect planning policies in up-to-date development plans?
Yeah, I wish I knew the answer, but I think.
So what?
Yeah, but I think. Well, I mean, I'm not going to put words in the mouth of the government, or in the RICS, but I think both bodies would be absolutely delighted if benchmark land values and real land prices converged because they became policy compliant. Do I think that's going to happen? No. And the reason I don't think it's going to happen is that I still think the PPG methodology does not fit how real people do real pricing in land markets. And once you get a mismatch in methodologies, why would you expect the answers to come out the same? So I think we've got to see this as a mechanism for getting to a value that fits within the same framework. That's why I make this point that you mustn't put a benchmark land value into a proper residual valuation, because it then, and make the POs the residual, because I think it just does not work. It opens the methodology issues up completely. So I think you've got to sort of get to a benchmark land value by the process that I've talked about, which is far more difficult because you've got to do 3 calculations instead of 1 or 2. But I do think it's well worth investing in this to get a more balanced answer. And it may sound as though I'm sort of batting on behalf of the local authorities here all the time. I really don't think I am. I'm trying to get a fair balance in the outcome. And if you talk to most people privately, I think they do believe that the government was right to change the PPG because the process was being gamed to some extent. And the theoretical view that we took was that planning obligations were actually going to be reduced to 0 in an efficient land market. The way in which the policy was working would actually lead to land prices wiping out, increasing land prices, wiping out contributions. That was the model that was being operated. So this is an attempt to balance that back again. So it's not to give the local authorities. It gives them a better hand because I think their hand was tied in the past. So it's reclaiming the balance rather than pushing it from one side to the other.
Thank you very much.
Paul, any other questions from yourself?
Yeah, okay.
And I'm going to unashamedly bat for the local authorities in relation to this one, Neil, because I've done almost 30 local plans over the course of my career with others in the pipeline. One of the difficulties I have with this whole process is it is unbelievably complicated.
Yeah,
there are dark arts. It's incomprehensible. I've done dozens of these things, and I don't profess to be in any way expertise in relation to them. And when I'm advising authorities that are trying to get a viability assessment to match what's set out in the forward of this document, to say this is going to be your starting point to underpin policies to prevent applicants coming back with viability appraisals and applications. When I'm advising complicated authorities with differential interests, with huge numbers of different interests coming with information, in an ideal world, all the surveyors should be working together. But in reality, that's not what happens. You end up with a complicated document, which frankly, few in the team will understand, and I include me with that, which is then meant to underpin an examination. And I don't know if you've ever been to an examination, Neil, but it's a horribly superficial exercise at which there's then a tax in relation to it, which are too complicated for most people to understand, which then set a baseline, which is frankly a compromise, which is then meant to be the absolute limit for it. So what on earth are we playing at, dragging this into the planning system? Why not just have a proper taxation system? That's not the question.
Easy question.
No, this is a question. If you are suggesting that viability and valuation, development appraisal within viability is hugely complex, then who am I to argue with you? I've made a career out of it, haven't I? You know, we wouldn't have a degree course in property valuation if it wasn't complex and difficult.
But Neil, my question is, how do you take that when you're looking at the totality of a local plan area, multiple sites, multiple inputs, multiple parties, to create something which goes through an examination and is a robust exercise? Because that's the intention behind this document.
Yes, it is.
Sum it up in about 2 or 3 pages. Help.
Well, all right. I'm not going to answer the question because I think it's straying out of the sort of the policy thing, and I'm trying. I mean, I've diverged quite a few times. Your problem is that development appraisal and development land values are incredibly site specific, never mind location specific.
Absolutely.
They are incredibly site specific, and any attempt to average over them is a problem. Now, what this guidance note is trying to do is put into effect the policy that the government has come up with. And sill is another one where, you know, could you imagine a fixed sill around the country on every single site, the same one? That would be pretty tricky, don't you think, in terms of, you know, Carlisle versus Oxford, and then, you know, sort of brownfield versus greenfield, all this sort of thing. I mean, I just think that trying to average over typologies, typologies, localities, is going to be a challenge for you all. We have set out the process as best we can, given the government policy and all the guidance there is. We've suggested that you take it local authorities take it very, very seriously indeed, because it will drive the plan, and if they skimp on it, then it may come back to haunt them. And I suspect that I suspect the landowners and developers are looking at this going, okay, the emphasis has changed, so we're going to put our resources into, instead of challenging every site, we're going to challenge the plan. Why wouldn't they? I mean, that's, you know, it's their business model, and they're protecting it, and that, you know, good luck to them. But it would be nice to know that it became a balance, and I think it's a really difficult task.
Yeah,
and I think the developers probably going to get into trouble as well, because they're going to have sites that are completely different, and some are going to be extremely profitable, possibly, and some are not. And if you've got the 3 that are not, you know, because averaging across something that's incredibly individualistic is a problem, and I think that's all I need to say, isn't it?
Obviously, my real question was why Brian Clough was never manager of England, but we can talk about that off screen.
Because of what happened at Leeds, obviously.
Yeah.
No, Tom Revie had the greatest manager in the world following him. He just gave him a month, that's all.
Yeah.
Chris,
that's the one thing I'm not going to argue with you with.
Final question from your good self.
Yeah, I really don't think it needs to be that complicated. I completely agree with Paul that it is too complicated. I just don't think it needs to be. I mean, we're talking about the price of bricks, and we're talking about the price of glass, and then we're talking about the cost of the labour. It doesn't need to be that difficult. The difficult.
Why not?
It doesn't. Because
cash flows are difficult.
No, it's not difficult. You're talking about building something, and I've just done a case, and we had a view about the build cost, and the other side had a view about the build costs. The profit is set by the PPG between 15. And 20.
I see what you mean. Within PPG, it's not that complicated.
No, it's not. I don't think it's complicated. It does.
So what are you going to do then? Stick the benchmark. How are you going to get to benchmark land value then?
I think the simple answer is you follow my own view, and you know my own view, which is you follow the Shinfield method, but perhaps.
Oh, okay. So
hang on, the 50% profit was probably a bit high. If it was 40%, and then after taxation, the landowner gets 30%, and the remaining 60 from the 40 goes on planning gain, I think that's a fair deal. Why does it have to be any more complicated than that?
Well, you know that all our research work has come to that conclusion as well. So you're not exactly preaching. You're not exactly preaching to the. But that's not the game that we're playing at the moment.
But don't you think we need to persuade the government to make it simpler? Because EUV plus, when you don't know what the plus is, it's just pointless.
But did you respond to the consultation on the white paper?
Yes.
Well, let's just say so did I.
Yeah, okay, all right.
Chris, is it not the case that the government has clearly indicated that they are moving towards a more of a taxation situation, which is exactly as you describe? Because as long as we have this fairly and reasonably related to the development, we can't have your approach, because your approach is to just come up with a percentage figure, which may end up being completely unrelated to the infrastructure that development site requires.
Yeah, but in terms of the infrastructure, the taxation system, the new system, I would love to know what that looks like. But I don't know what that looks like, and I don't know how you're going to fund the roundabout in the first place. We're being told it should be forward funded. I don't know how it's going to work. So yes, Mary, this may become all completely academic in 2 years' time, but for the moment, we are all out there fighting appeals and dealing with appeals and dealing with local plans where this is all an issue.
Big issue. Yeah, absolutely.
The one clue is that MHCRG in December advertised for a vacancy for implementation manager for the infrastructure levy. So I think that gives you a fairly...
Yeah, but I think that's because somebody else left. I don't think it's a new post.
No, but I think the job description rather gives you a clue as to what the outcome of the consultation is going to be.
Well, Charlie, they have been recruiting a lot of people with tax expertise. So Mary is spot on. I mean, we are heading to a straightforward taxation system, and I think it just doesn't need to be this complicated.
I was very rude in saying, Chris, that you had the final question. I look, Sasha, in my defence, Sasha and Paul in my opinion have blended into one person, given their sartorial similarities.
I thought it was Paul and Sasha because they've got almost the same stripes on.
Right, Sasha, have all your questions been
Oops, wrong thing there. I've upset somebody.
They absolutely have. I'm
Lovely.
I'll be fine.
I'm just going to Neil as my junior on my next viability case.
Absolutely. Neil, thank you so much indeed. It's been really invaluable to get your unique insight into the genesis and content of the guidance note, its purpose, and what might the future hold. So thank you, and to have that intellectual underpinning as well. It's been really fascinating. So
absolutely. Charlie, I do have one question actually. I've just thought, Neil, favourite ever Forest player?
Tricky.
Oh, it is, and Peter Shilton.
I don't know. No,
shortest goal ever.
I quite like Stuart Pearce.
Okay, yeah.
Oh yeah.
Okay.
Can't beat Stuart Pearce, can you? And
I've done a few tackles like that before as well. So he was my role model.
Oh, no, to be fair, Sasha, you have asked by far the clearest question.
On that note, thank you very much indeed. Thank you to ICS indeed as well for putting you forward and suggesting this show. We look forward to returning for our 4th series on the 22nd of April. So about 3 weeks away, give or take. So look forward to that. Thank you very much. Goodbye.
Yeah. Thanks for having me.
Cheers, Neil.
Thank you very much, Neil.
Brilliant.
Bye.